I've officially hit my 5-year investing milestone, and the results are in. In 2025, I have achieved 31% annual return for my portfolio, which also means I now have an average of 20% plus annualized return in the past 5 years, beating both the S&P 500 and the NASDAQ. But even with a 31% return this past year, I've made mistakes that cost me significant gains. In this deep dive review, I'm sharing the lessons learned from my 5-year journey. We discuss the massive opportunity cost of my Palantir option strategy, the pain of being down 60% on a high-conviction play like Novo Nordisk, and why I finally decided to exit my China and SEE limited positions after years of underperformance. Before we start, make sure to like and subscribe for more content like this. This is my 3rd straight year of beating the S&P 500 by double-digit gains. In a market where most professional fund managers struggle to keep pace, my portfolio has more than doubled in value over the last 5 years. I've managed an annualized return of over 20%, comfortably ahead of the NASDAQ's 15% and the S&P 500's 13% over that same period. But today isn't a victory lap. I'm up 31% this year, yet I'm sitting on a 60% loss in my largest trade position, and I've left potentially 6 figures on the table due to a single strategic error with Palantir. Let's talk about Palantir, PLTR, the largest position in my portfolio. I'm up over 870% on my remaining shares, but I made a terrible mistake. Last year, I sold covered calls with strike prices that were extremely low compared to where the stock is now. Those options expired this year, and I was obligated to sell away a significant portion of my position. While I didn't lose money, I took back my original capital plus healthy profits. The opportunity cost was staggering. If I had simply held and done nothing, my portfolio value would be significantly higher today. Currently, excluding one final call expiring in February, my PLTR position is 100% house money, risk-free capital I'm holding for the long term. Moving on to my second largest position, which is Novo Nordisk. This is a masterclass in the dangers of overallocation. It currently represents my largest trade value, but I'm sitting on a 60% loss. I remain extremely optimistic about the company's future and its role in the healthcare revolution. But from a portfolio management perspective, singling it out with such high weight was a mistake. However, there's a silver lining. Despite NVO being my second largest position and being down 60%, I still beat the market by 31% this year. That proves the rest of my engine is firing on all cylinders. Now let's talk about the 2 pillars of my technology allocation, Alphabet and Microsoft. These 2 currently make up nearly 20% of my entire portfolio. I've become extremely bullish on Alphabet. I believe they are the #1 beneficiary of the AI hyperscaler race. Alphabet is a standout winner for me, up 129%, and now my 3rd largest holding at 11.94%. Earlier this year, there was a lot of AI noise suggesting Google had fallen behind, but the performance tells a different story. In 2025, Alphabet's stock soared roughly 65%, significantly outperforming Microsoft's 16% gain. Why am I so bullish? It's the full stack advantage. Alphabet isn't just building software, they have a decade-long lead in custom AI hardware with their tensor processing units, or TPUs. While competitors are still heavily reliant on external GPU supply, Google Cloud's revenue surged 34% last quarter because they can run AI more efficiently and at a lower cost. I believe Alphabet is the #1 hyperscaler beneficiary because they own the chip, the model, Gemini, and the distribution. This is a compounding machine I'm happy to let run. Then there's Microsoft. It's a core anchor for me at 7.76% of my portfolio with a 23% gain. Microsoft is essentially the digital operating system for global business. Their cloud platform, Azure, grew 30% plus for 9 consecutive quarters, only slowing down because they literally ran out of server capacity. For 2026, Microsoft is planning a massive 45% increase in capital expenditure to build out that capacity. They have one of the highest certainty of recurring revenue in the space. Before I forgot to mention, I have exited my Apple position entirely around Q3 in 2025. I felt Apple's AI story was moving too slowly compared to the rapid monetization we're seeing at Google. I'm reallocating that capital towards Alphabet because I want to be where the infrastructure is most integrated. In 2026, I expect to see the AI realism trend continue, where the market stops rewarding hype and starts rewarding the companies that own the entire tech stack. Next up, we have Tesla, one of the longest-standing positions in my portfolio. I'm up 106% here all time, but it's only 3.64% of my portfolio. In 2025, we saw the market grapple with Tesla's margins and the timeline for FSD and robotaxi. Looking forward to 2026, I view Tesla not just as a car company, but as an AI and robotics play. It's a high-conviction position, but it's one where I am comfortable with a smaller allocation. The volatility is too high to make it a top 3 holding for me right now, but the potential for a 2026 breakout in their energy storage and software margins keeps me firmly in the hold camp. Similar to Palantir, I have taken some profits along the way, so whatever remaining in my portfolio is 100% risk-free position. While everyone is focused on the software and the LLMs, let's not forget all the picks and shovels. This brings me to 3 of my holdings: NVIDIA, ASML, and CrowdStrike. These aren't just growth stocks, they are the gatekeepers of the AI era. Let's first look at NVIDIA. It's been a massive contributor to my 56% gain in that position. As someone who follows the semiconductor industry closely, I'm watching the transition to the Blackwell architecture and the evolution of photonic integrated circuits. However, for 2026, we have to ask how much of this is already priced in. NVIDIA is a core holding for me, sitting at nearly 4% of my portfolio. While the AI tailwinds are undeniable, the law of large numbers is starting to apply. My plan for 2026 isn't to chase the hype, but to hold my current position and only add if we see a significant valuation reset. Next up, I think we can all agree that there's no AI without ASML. They are the only company in the world capable of manufacturing the EUV lithography machines needed to print the 2nm and 3nm chips that power NVIDIA's H100s and Blackwell GPUs. As we look towards 2026, the transition to high-NA EUV is the next big catalyst. These machines cost over $350 million each, creating a massive barrier to entry. While the semiconductor cycle can be lumpy, ASML's backlog remains a testament to the insatiable demand for AI compute. To me, ASML is a buy-and-forget position because they own the monopoly on the most complex manufacturing process on Earth. Next is CrowdStrike, which has been a stellar performer for me, up 159%. It's currently a 1.88% position in my portfolio. Again, the small portfolio allocation is the result of my profit-taking, and the remaining position is 100% risk-free. Why is CrowdStrike's future bright as AI booms? Because AI is a double-edged sword. As hackers use AI to launch faster, more sophisticated living-off-the-land attacks, companies have no choice but to fight fire with fire. CrowdStrike's AI-native Charlotte AI allows security teams to automate threat hunting in ways that were impossible 2 years ago. In an AI world, cybersecurity isn't an extra cost, it's an existential requirement. That's why CrowdStrike remains a high-conviction hold for me. For the fuss-free side of my portfolio, DBS Bank continues to be a rock star, providing both capital growth and reliable dividends. To bolster my passive income, I've also moved to private credit via BXSL. Even with the 30% dividend withholding tax, I'm netting over 7% annually. Combined with my Singapore REITs, which I expect to continue recovering, I'm building a solid floor of passive income to weather any tech volatility. Apart from that, this year was also about cleaning the house. I finally closed the chapter on my largest losers, Baba, Tencent, and SEE Limited. I managed to exit these at break-even or slight green during the recent earnings rallies. My China exposure is now less than 1% of my portfolio, consisting only of legacy positions in Haidilao and Meituan that I am no longer adding to. Looking ahead to 2026, I'll be honest, US valuations look extremely stretched. I'm not rushing to add heavily right now. My portfolio is currently the most balanced it has ever been across tech, healthcare, REITs, and financials. My plan is strategic patience. I will keep my capital ready and only allocate heavily during market pullbacks. We've had a great run, but the next phase of this 5-year journey is about protection as much as it is about growth. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for my portfolio overall review for 2025 and some basic investment plans for 2026. Let me know in the comments what you think. See you in my next diary.